Hello, and welcome to episode 133 of the REconomy Podcast, where we discuss economic issues that impact real estate, housing, and affordability. If you find this type of real estate economic discussion valuable, please be sure to hit the like button and subscribe to help us grow this podcast. I am Odeta Kushi, Deputy Chief Economist at First American, and here with me is Mark Fleming, Chief Economist at First American. Today, we're going to lay the foundation for the new home outlook, frame why builders are leaning on incentives, and see where the market might creak in 2026.
Frame, foundation. Could you fit any more home building puns in your sentence?
I just wanted to reinforce today's theme, but I will try to keep this episode up to code.
I feel like if we can fit rebar in here somewhere, but that was already a lot. Huh?
Yeah, I get it a lot. I get it. But we'll stop now before the listeners file a permit complaint.
Good, because this conversation was starting to feel a little bit overbuilt. Okay, now we're really done. We're really done.
Yeah, we're really done because we do need to get to the data. And we want to start with the fact that new home sales have actually been doing better than resales. Builders are leaning on incentives. And so we want to unpack the outlook for the new home market, plus what rate buydowns really mean for prices, margins, and of course, supply.
True. New home sales through the latest data in 2025 have been about 14% above pre-pandemic norms, while existing home sales have been nearly 25% below pre-pandemic norms. So new home sales have been surprisingly resilient, but the fine print is doing a lot of work here.
Yes, the resale market, as we know, is still constrained by that famous or infamous, rather, lock-in effect. Homeowners with low mortgage rates have less incentive to move, so existing inventory stays historically tight, though it has improved. Builders, on the other hand, can create inventory and they can create affordability.
They can build it in, if you will. They can't change the 30-year mortgage rate, but they can change your monthly payment. It's like the choose your own rate adventure of housing right now.
I can't tell if that was a subtle 80s reference or not.
Indeed it was.
Of course.
I was going to be cool about it, but since you did point it out, I think it deserves a pat on the proverbial back.
Well done, and very early into the episode. So again, double kudos there. But indeed, the data does show what you're describing. New home sales jumped to an 800,000 seasonally adjusted annual rate in August. That's the highest since early 2022. The Census Bureau does remind us that early estimates can be revised, but it takes a few months to establish a trend.
And the Economist's translation of that is nice print, but don't tattoo it, if you get my drift. Still, even smoothing through volatility, new home sales have held up because the reality is that builders are the only group actively selling affordability. See that, right? Nice, right? Actively selling.
That was really bad, but it's true that incentives are the tell. In December, the National Association of Homebuilders reported incentives used by 67% of builders. That's the highest percentage in the post-COVID period, with 40% of builders cutting prices.
But it's also important to note that incentives aren't just a perk. They're market clearing, which is why we should take them seriously as a signal of demand versus supply.
Well, we've mentioned incentives a lot, so let's actually define it, because it's not just getting a free refrigerator. We have mortgage rate buydowns or financing incentives. Those can be temporary or permanent. You can have closing cost credits or upgrades and options like design packages, appliances like that refrigerator I mentioned, or landscaping.
That's right. And now rate incentives are clearly the star because buyers shop the payment, not the price.
Exactly. Builders also have strong reasons to prefer buydowns over big list price cuts. Broad price cuts can reset comps for the whole community, create appraisal issues, and worst of all, create a fairness problem for buyers who are already under contract.
Yeah, that's when you get the call, why is my neighbor getting a better deal than I did just a few months ago?
Yeah, that's not a fun call to field, I imagine. So instead, builders keep the headline price steadier and shift the concession into financing. Though we have also seen price cuts, as I mentioned in the NHB stats. Now, that's one reason the new versus existing price gap has shrunk. The traditional premium on new homes has essentially disappeared, and I think that matters a lot because it changes the competitive set. New construction becomes a closer substitute for existing homes.
That's right. So incentives can act like a price cut, just not one that shows up in a giant sticker. And it means median price data may be misleading. List prices might look stable even as effective prices are softening through concessions.
All right, that all brings us to how exactly do rate buydowns work? Because a builder buydown is when the builder funds a closing credit that reduces the buyer's mortgage payment, either by paying discount points for a permanently lower rate or by subsidizing the first year or two of payments in a temporary buydown.
And permanent buydowns are more expensive, which is why they matter for margins. As a useful rule of thumb, according to an analysis from Evercore ISI, buying down a 30-year mortgage rate by 100 basis points or 1 percentage point can cost builders roughly 3.5% of margin. That's not pocket change.
No, that is not pocket change. And here's a nuance. Builders don't price incentives as market rate minus X. They market the menu rates like 3.99% or 4.99% that are sticky and adjusted to keep sales moving. So if market rates fall, the gap they're subsidizing to deliver that 4.99% menu cost shrinks, which makes incentives cheaper and takes some pressure off of margins.
It's like builders are running a promotional rate menu, like it's 1987 and we're choosing between the Camaro and the IROC Z.
What?
Never mind. Keep going, keep
What's an
going.
IROC Z? Okay,
Don't
that
worry about it.
sounds like a band. Okay, well, we should note that playbooks will also differ by builder. At the higher end, according to analysis of Toll Brothers Q4 earnings from Evercore, Toll Brothers reported incentives around 8% or about $80,000 per home and said rate buydowns have a relatively low take rate because higher end buyers often prefer to use incentive dollars on upgrades.
Of course, I will take the chef's kitchen, please, over a quarter point off my rate.
Love a chef's kitchen.
Mhm.
Meanwhile, more rate-sensitive, volume-focused builders tend to lean harder on financing. Lenars said demand was challenged and incentives remained elevated around 14%.
14%, that's not just a free refrigerator. That's we are extremely motivated sellers and we're trying to move this inventory.
That's right. And there's also a second layer to this, how builders fund these incentives. Some large builders have used what's called forward purchase commitments. You might see those as FPCs to effectively deliver larger financing concessions. That matters because there are guardrails. Concession limits vary by loan type, and depending on structure, some builders may be bumping into or navigating around those limits more than others.
So there are real guardrails. There is no proverbial free lunch here.
Right. And another estimate from Evercore and AEI suggests that for some builders, roughly 20% of sales could have been above concession limits if certain buy down costs were included, while other builders were far less exposed. So the bottom line here is that the incentive lever can't be pulled indefinitely or infinitely, rather.
Well, any good economist knows that rarely is anything unlimited. I mean, we are the people of scarcity, right?
That's right. We are the study of scarcity. Now, okay, let's connect incentives to supply because the outlook depends on inventory and housing starts. Also, when we talk about inventory, it's really the completed and under construction homes that pressure pricing more than the not started units sitting on a spreadsheet.
I like that, not started units sitting on a spreadsheet. We're going to have to use that one a little more often because it's so true. Builders have responded by slowing starts, the ones not on a spreadsheet. Single family starts fell to an 890,000 pace in August, our latest construction report as of this recording due to the government data shutdown. And we're down nearly 12% from a year ago. Homes under construction were also down from a year earlier, another sign that builders are managing that pipeline. Less future new homes for sale, less risk of oversupply.
And surprise, surprise, there are regional variations.
It's like real estate's local or something?
I knew there was something to that adage.
Indeed, there is. Year to date combined starts were up in the Midwest and the Northeast, but down in the South and the West was roughly flat. Permits, our leading indicator, were down year to date in every region.
Which matters because the South is sort of the volume engine for new construction. If starts and permits cool there, that can help prevent inventories from ballooning, even if monthly sales sort of bounce around.
And this connects to another key point, which is demand isn't only math, it's sentiment. Even when rates move down, buyers don't always show up in proportion, especially if they're feeling uncertain about the economy or their job. Buyers need confidence, not just calculators.
Yeah, this is a point we talk about a lot. I think it's not just the math, it's also buyer sentiment. Okay, so before we do the formal outlook, let's connect this, I think, to what listeners actually experience. So if you're someone that's shopping new constructions, two homes with the same list price can have very different all-in economics depending on whether the builder is buying down your rate, covering closing costs, or giving you options. That's why it's worth comparing the monthly payment and the cash to close, not just the sticker.
And for existing home sellers, this matters too, because when new home incentives rise and the new home price premium compresses, builders become tougher competition at the margin, especially for homes that look and feel similar.
Right. And another builder nuance is incentives don't have to mean sell more specs. Some builders are actually trying to tilt away from spec and toward build to order. KB noted that gross margins are 3 to 5 percentage points higher on build to order sales than on spec. So they're targeting a much higher build to order mix over time.
That's the less inventory risk, more customization strategy.
Right. And I think that's also where cycle times matter. Faster build times make build to order more compelling because the wait time gap shrinks. We've also seen builders highlight improvements in cycle times. Somewhat incremental, but I think helpful for capital efficiency and some flexibility.
All of those faster turns actually help margins and flexibility, but they don't necessarily eliminate rate sensitivity.
That is true. Before we wrap, this conversation on term times actually reminds me of one thing I want to make sure we touch on, and that's productivity. Single-family construction productivity has really stalled over the last 3+ decades. And recall that productivity from your Econ 101 class is computed as output divided by input. And when we look at that construction productivity data going all the way back to 1987, we see that productivity did rise in the 2000 to 2005 period. That was primarily driven by a big increase in output. Then beginning in 2005, we saw output fall through 2009 at a faster rate than hours worked, which means productivity declined over that period. Those would be your housing collapse years. Productivity then increased from 2009 to 2013 and then sort of weakened through 2019. In the more recent periods, we see productivity increase in 2020 and 2021, fall back down in 22 and 23, and then rise again in 24. The productivity gain we saw in 2024, our last available data, we saw a 6.1% increase that year, following a rise in output of 5.9%, while hours worked were actually pretty steady. So all of that to say, when we zoom out entirely and look at this full history going back to 1997, there's volatility along the way and rises and falls, but actually in 2024, productivity for the single-family residential construction sector is basically at the same level as in 1987.
So, no AI disruptors yet in the productivity of construction since 1987. You still need more hammers at work to build more homes. Okay, outlook time, Odeta. Give me a base case, tailwinds, and the what could go wrong.
Well, we are dismal economists, so we do need to include that part. Well, as a base case, I would say new home sales remain relatively supported compared with resales because builders can bridge affordability with incentives. Builder sentiment is still subdued, so we should expect cautious production and continued incentives.
And if you don't mind, since I'm such ever the optimist, I'll do the tailwinds. If
Okay.
mortgage rates drift lower or even just stop rising, just stay the same. The cost of buy downs can fall and relieve margin pressure, and slower starts and softer permits should gradually work down excess spec pressure.
And Debbie downturn is back with the headwinds and downside. Incentives are already high and there are practical limits to concessions. So if rates move higher again, the affordability bridge gets more expensive. More money, more problems. And some builders may have to choose between preserving margins and preserving volumes. And if sentiment stays shaky, lower rates alone may not generate a big demand pop.
Wait a second. I had to let you finish this, but is that a subtle 90s rap reference? Mo money, mo problems, Odeta?
I decided if you get the 80s, I'm calling 2026 the year of my 90s references.
And so with great trepidation, the year begins.
Indeed, it does. And just one final takeaway for the episode, the new home market has been the flexible part of housing. Builders can flex incentives, product mix, and of course, housing starts, but those levers have costs and limits.
And if you're listening and thinking, I just want a house, remember, builders can be the most negotiable sellers in a locked-in market. You may not see it as a price cut, but you might feel it in the monthly payment.
Nailed it. Sorry, couldn't resist one more pun. Thank you for joining us on this episode of the REconomy Podcast. If you have an economics-related question you'd like us to feature in the future, you can email us at economics@firstam.com. And as always, if you can't wait for the next episode, you can subscribe to our Econ Center at firstam.com/economics or connect with us on LinkedIn. Until next time.
Thank you for listening. You can find even more economic content at firstam.com/economics. This episode is copyright 2025 by First American Financial Corporation. All rights reserved.